So what exactly is diversification, and are you using it to its fullest extent to improve your personal finances? That's what we're going to be talking about today. Let's get moving forward. Hi everyone, welcome to the Plan Ranger, where our goal is to provide you with informed insights and a reasonable approach for managing your personal finances. So we'd done a video a couple weeks ago about asset allocation, which quickly touched on the topic of diversification, but we mentioned in that video that we'd be doing another segment to touch on that, and so that's what we're going to be talking about today. What is diversification? To start right off the top, diversification is a way to reduce risk. When you use diversification, the premise is the proverbial don't put all your eggs in one basket, right? And that's why we use diversification, to not put all your eggs in one basket. The eggs in the basket metaphor, though, is a little bit exhaustive, I would say, and maybe doesn't touch on how diversification can really benefit you as much as possible and how most people actually use it. In this video, what we're going to talk about real quick here is kind of two parts here. We're going to talk first and foremost about the more commonly known way of using diversification, which is in your investment portfolio. But then we're going to touch on after that some ways that diversification can actually benefit you in multiple parts of your financial life that you may or may not be aware of, as far as this concept applying to those parts of your life too. First, though, let's dig into the investment side. As we do that, we want to touch on that eggs in the basket metaphor, or actually provide you with one that's a little more user-friendly and perhaps paints a better picture. Picture this if you can with me real quick. You're at a shoreline standing at the edge of the ocean, and you've got all of your money there in your hands, and you need to get your money to the other side of the ocean. Now, the way to do that would be to choose one or any of the multiple boats and ships that are lined up along the shoreline. You can choose to take your money, put it in one boat, or you can put it in all of the boats or some of the boats or many, or however you want to do it. But the second that you make that investment, all of those boats are going to take off from the shoreline that you're standing at, and they're going to go to the other side. Ideally, the quicker you get your money to the other shoreline, the better. Let's just assume that when the money gets there, you can do something you've been wanting to do for a while, like retire or take a vacation or whatever, buy a car, buy a house. The premise is that the quicker the money gets to the other side, the better it is for you. Now, the ideal scenario would be that you chose one boat, put all your money in that one boat, and it was the first boat to get to the other side. All of your money arrived to the other side as quickly as possible. That's the ideal scenario. But what you have to consider is that when all these boats take off, one of them is going to be first and one of them is going to be last, and some of them may never make it at all. Some of them might sink partway through. And that's usually reason enough for your average person who's out there deciding how to allocate their money to say, you know what, I just can't take the risk that my boat's going to sink, that somebody's going to have to go all Jacques Cousteau looking for my money. So they'll diversify across a range of boats, and they'll say, you know what, I'm going to put some here, some there, some there, just in case one or two of them sinks. The fact that boats can sink, that companies can fail, that stocks can fail, that funds can do bad is usually enough reason for people to start diversifying, right? And let's say that you were going to pick just one stock, or in this case, one boat to take your money from one shore to the other. What type of research, what type of due diligence would you do on that boat? You'd take time, you'd look at every inch of it, probably looking for holes. Is there a hole in the bottom of that ship, in the hull? How are the sails? How's the motor? Whatever you look at on the boat, that's what you're going to look at. And in addition to that, you'd probably want to know about the captain and crew. Maybe this boat has a great track record. Maybe in times past, it's been the first boat, or it's usually been one of the first boats to get to the other side. It's performed very, very well. But maybe the captain's brand new. Maybe this is his or her first time ever piloting that boat, that ship. So you'd want to know as much as possible about the captain, the crew, the ship. And that amount of research and due diligence can take a lot of time and expertise. And this is where, sometimes when people diversify things like ETFs and mutual funds and things like that, they relieve themselves of that burden of having to know everything possible about, particular ship, or having to do the investigation, the research, because it's not enough just to know about that one ship. You'd want to be able to compare against other ships too and be able to say, okay, well, this one's the best. Here's why it's better than that one and that one and that one and that one. And so it's not just you have to do your due diligence on one of them, you have to do your due diligence on basically all of them, or at least a large amount of them. So when you diversify through using something like an ETF or a mutual fund or something like that, you're kind of relieving yourself of that burden of having to look at each and every individual ship and possessing the expertise in order to ascertain whether or not those ships are better in the first place. So one, some, many, all, you can take your money and you can put it on one boat. You can put it on some of the boats. You can put it on many of the boats. You can put it on all the boats. Let's say theoretically you were to take your money and put it on just one. Okay, your money could get there first or it could get there last. It may never get there at all. So we understand those circumstances. Where this gets a little more interesting and a little more commonplace, I'd say, with people and investors is, if you take that money, you diversify, you put it on every boat out there, let's say in equal amounts across every single boat. Theoretically, your money is going to get there. The time it would take to get to the other side is going to be the average of all of the boats. That would basically be like buying an index fund. You'll hear people talk about like an S&P index fund. There's a plethora of index funds out there that you can use that measure an index, and they try and do it as cheaply as possible, generally speaking. Putting your money on all of the boats would basically be like buying an index fund. It would be not trying to be there first, but also not being there last, accepting that, hey, you're going to get the average return, that benchmark return for all of the boats going from one side of the sea to the other. Now, as we talk about kind of the average returns and index, things like that, this kind of brings us to an interesting next point, which is especially in the investment world. When we're talking about your portfolio and how you can diversify and things like that, there's actually a couple of types of risks that you need to keep in mind. In generally speaking, in the most simplistic terms, they're unsystematic and systematic risk. What we've been talking about, the idea that you can take money and put it on one boat or many boats, the fact that one of those boats will get there first, and the fact that some of those boats might not make it at all, some of them might sink. Those are factors of unsystematic risk that you can diversify away. The more positions or stocks or investments you hold in your portfolio, the more you're diversifying out unsystematic risk. So diversification works for that. So while you can choose the boats and you can try and mitigate the risk that a captain has no idea what they're doing, or that boat has a hole in the hull or something like that, you can diversify that out. But what you can't diversify out is the sea. When all these boats take off, the sea is going to do what it does. And if a tsunami rolls through, or a hurricane, a typhoon, or something like that, think 1998 with long-term capital, think 2008, think the COVID crisis. There are just times where systematic collapse occurs, and that's the ocean, the sea, just doing what it does, right? There's not really much you can do to diversify that out of the equation. Now, there's layers to diversification. So when we talk about it and we talk about the sea, and there's not much you can do to diversify out the system. So you've got individual companies, right? Let's just kind of work our way down here. You have individual companies, and you can start by diversifying out on systematic risk by buying, let's say, instead of one stock, you buy two. And instead of two, you buy 10. Instead of 10, you buy 50. The more stocks you're owning in there, the more you're kind of smoothing out the curve of risk that occurs that you can eliminate, of unsystematic risk through diversification. But what if all of those stocks that you own are in what's called the same asset class, like the S&P 500? And this is kind of a reference to our asset allocation video that we did a couple weeks ago, which we'll go ahead and put in the link up above here, so you can check that out if you want to. But if they're all within the same asset class, they're going to still kind of do the same thing. They're still kind of exposed probably to the same tax risk, the same regulatory risk, and things along those lines. And they tend to kind of fluctuate together. The idea that you buy Unilever and Procter & Gamble, those companies are going to operate pretty similarly. The fact that you buy General Motors and Ford, even Tesla, things like that, those companies might move kind of in lockstep together. And so generally speaking, you want to have more than one asset class. So your first thing to do is kind of hold more than one position. So instead of one stock, you hold multiple or something like that. But realistically speaking, the next layer beyond that is to diversify among asset classes. Instead of holding just large companies, you hold small companies. You hold companies that are growth oriented. You hold companies that are in other countries, that are international. You hold maybe bonds or things like gold, silver, commodities, cryptocurrency, any number of things that can help diversify your portfolio. And among financial professionals, when we look at building portfolios and we look at investment management, the kind of way that we look at this and we measure to a certain degree how well their diversification is working is we talk about something called correlation. Now we're getting into the technical piece here, so I'm sorry. I'll try and make this quick here for you. But correlation is what we use to measure, how well diversification is working, and how more, I guess specifically, how two or more asset classes or assets move in relationship to each other, okay? So let's take General Motors and Ford. Those two things are probably going to have a pretty high correlation. They're going to move in a very similar fashion. And correlation can move from basically +1 to -1 and then 0 in the middle, of course. Things that move together, like General Motors and Ford, they're going to be closer to a +1, right? They're going to, if one goes up 5%, the other might go up 5%. And so these things are going to kind of move up and down in the same pattern together. Versus things that have a negative correlation, if one goes up, the other goes down by the same amount, basically, right? So the more you go towards -1, there's still correlation there, it's just negative. So, some people might think that's diversification, but it's actually not. The kind of holy grail, what we're looking for here is good investments that are close to 0, that would have what's called a neutral correlation, right? So what one does is completely independent of another. So let's take, for example, General Motors again. Let's look at their stock, and let's look at something like gold or treasury bonds or something like that, or international whatever, that has 0 relationship to whatever General Motors stock does in a particular day. The fact that, this goes up 3%, this asset over here might go down 2%, but they're completely unrelated to each other. They might be closer to 0. And that's kind of the goal with diversification, is to get kind of close to that. So if you're working with an investment professional and they start talking about correlation, that's kind of what they're referring to. Or if you're building your own portfolio and let's say your online broker-dealer provides you with tools where you can look at the correlation coefficient, that's what you're looking at there, from +1 to -1, 0 in the middle. You want to try and find good investments that still meet your investment criteria, that are close to 0 as possible. So that's basically how you would apply diversification to your investment portfolio. But here's the thing, diversification can apply to multiple facets of your financial life. So one of the most interesting areas where it can apply is actually to your taxes. So when we talk about tax planning, there's actually this really kind of interesting tool called the tax triangle that tax professionals and investment professionals and financial planners will talk about with clients, where we talk about the different types of money that you can use. So you might hear people talk about traditional IRAs or Roth IRAs or 401ks, 403bs, 457s. No, use life insurance, use municipal bonds. Use a regular investment account. All of these things are kind of different. There's 3 different types of money that you can use to diversify your tax base when it comes to your investments. Why would you do that? You do that because there's risk involved in this. Let's say you take all of your money and you do it all pre-tax, because you say, you know what, I'm gonna do my 401k, I'm gonna do traditional IRAs, I'm gonna do everything pre-tax. Then let's say 20, 30 years in the future, when you go to take that money out, tax rates have doubled for some reason. For you, you've done really well, whatever. You have basically now exposed that money to what could have been a lower tax rate when you put it in, to a much higher tax rate now. We don't know what taxes are going to be in the future. And so in a lot of cases, the best approach is to diversify, to say, you know what, I'm going to have some in Roth. I'm going to have some in my traditional, my pre-tax pool, and I'm going to have some in a non-qualified pool, so that when I show up to retire at 60, 65, 70, whenever, I'm going to have these different bases of money that I can pull from and have more control at that time over how I maneuver my money and how I reduce my tax burden as much as possible at that point. So because the future is uncertain, there's risk there that you might end up paying higher taxes then than you would now. And so the best approach there is just to diversify. Now, you can also use this when it comes to insurance companies, things like, your life insurance policies and annuities, things along those lines, which, by the way, those are managed at the state level as far as backing, state guarantee goes. So just be aware that if you're going to kind of really dig into this piece of it, you're going to want to look at your state guidelines to figure out exactly what the thresholds and limits are. But let's just take, for example, a life insurance policy. Let's say you needed $2.5 million of life insurance. You might not feel comfortable doing all of it with one company. Maybe you want to take some and do it with, $1 million and do it with one company, take another $1 million, do it with another, and then $500,000 with a third company. Maybe you want to diversify the types of policies that you're using, even to provide different benefits for different reasons in the future. There are lots of people out there that have an insurance portfolio that's, hey, I've got this slice that's for this slice for that, and it makes a lot of sense to take that approach. You can do it with your bank accounts. Talk to anybody that grew up in the Depression that ever saw a run on banks where, hey, my bank became insolvent. What happens to my deposits? Well, there's the FDIC now that, covers most institutions, let's just say, but not all of them. And so you can take some money, put it in this bank, take some money, put it in that bank, and you can diversify that way too. Finally, you can, the big trend now is to diversify income streams. And so you're seeing people out there talk about, my 7 streams of income that do this. When you're younger and you're in your developing stage, it's a nice idea to think about that. Hey, I like the idea of having 5, 6, 7 different income streams right now, because why should I rely on one? I'm going to kind of throw kind of a thing out here, because people are kind of manipulating what multiple income streams are. That is something that's traditionally applied to retirement planning, because once you're no longer working, you need multiple sources of income, because what happens if one of the legs on your stool breaks, right? You still need more legs to be able to sit on and stand on. And so retirement income planning really deals a lot with this, which is having multiple income streams. What's happening now, though, especially among the internet world, is people are talking about having multiple income streams to diversify your income, which can be great. There's a lot of sound reasoning to it. But to somebody who's 30 years old, 35 years old, you should have 4 or 5 streams of income. You should have rental income, this, and this. Let's keep something in mind. When you start talking about dividend income and rental income, things like that, those would be the normal types of income that you would have as an investor. The idea where this is becoming a little bit manipulated is people are saying, hey, I make $2,000 a month on my passive income streams. Okay, but are you actually taking that and spending it? Are you living on that? Because if you're taking it and living on it, right now, instead of letting that grow, reinvesting it back in, you're going to have a heck of a lot less money in the future than most people who take that passive income and they reinvest it. Dividends aren't new. They've been around for a very, very long time. The idea that dividend investing as a passive income stream is something new that's completely false. So when you hear people talk about that type of stuff, I just say proceed with caution. You can develop passive income streams. You can develop more than one income stream. You can have a side hustle, which we used to call having a second job, just so you know. You can have a second job. You can develop passive income streams. But frequently developing passive income streams is not just like snapping your fingers. I mean, if it was that easy, if it was just, I'm just going to write a few articles and then, advertisers are going to pay me for what I wrote or whatever. I'm going to, do this, develop this product, or I'm going to sell, whatever the way is that you think you're going to develop that passive income stream, it's probably going to take a lot of work on the front end. And you're going to have to make an opportunity cost here, a decision as to which would your time be worth more plowing it into your main occupation to grow and develop in that company or in your own business or something like that? Or hey, I'm a school teacher, there's really not much further I can take this from a professional standpoint. In that situation, maybe I should look for some outside income streams to develop, to grow my income or create some more stability and minimize the risk that if I ever leave this job, that I've got this over here, so you can do it from an income stream level as well, but just kind of be cautious there as far as that goes. But diversifying your income does make sense. It's just probably for people later on in life. So, well, hopefully that kind of helps clarify what diversification is and some other areas of your life that you can actually use diversification to reduce risk a little bit. That's all we'll have for today. We'll go ahead and just stop right there. If you have any questions, please feel free to leave them down below in the comments. Click like, subscribe, join the Plan Ranger community. We'd love to have you. And if you know anybody who's struggling with their investments or their personal finances in general, please help us help them. Share this video with them. Help supports the channel, and it helps those people out too. Hopefully provide them some good information. Until next time, thank you very much for taking the time. We hope this helped.